Greetings from the USF and dealers. Thank you for joining the marketing course for startup founders and their teams, created by the Ukrainian Startup Fund and the innovative marketing agency iDealers. As we continue with our series of workshops, it is my pleasure to introduce our next speaker, Dasha Kichuk, CBDO at iDealers and CEO at EFA. Today, Dasha will guide us through a crucial aspect of startup success, which is fundraising. So let's move to the key part. Dasha, the floor is yours. Please take it away.
Hello, everyone, and I hope that you're doing great and you are getting ready for your fundraising. And hopefully, some of you have made some success in terms of your fundraising. But today, I'm going to get a bit deeper into fundraising strategies, into how the VC industry is operating, who are the main players, how to create your fundraising strategy in the best way possible, how to outreach the VCs or angels that are best for you. And yeah, let's dive a bit deeper into that. I kindly ask you to be as active as possible in this workshop because you have one chance today to listen to my experience, and you have me for the full hour to share all of my experience that I have. So please ask your questions. Don't be shy, because maybe you will not have another chance than this. So be as active as possible. Okay, let me introduce myself. I'm Dasha. As Yana mentioned, I'm CBDO at iDealers, and I'm also CEO of EFA. Maybe some of you know me better as a CEO of EFA. I have already raised, here is at $600K, but technically is over $800K for my startup, and I have helped a lot of different startups with their fundraising strategies and with their fundraising. I've also finished Pfeiffer Global Acceleration Program last spring. It has been almost a year, and it has taught me a lot, and I will share this information with you guys. I have a really strong network with the VCs in Silicon Valley, all over US, and in European Union as well. I've talked to a lot of them. And I know really good the leading VCs in the United States. So I'd be really happy to share more information with you guys. I've done sales to Netflix and Airbnb and a lot of other enterprise corporates out there. I've grown my company, and I know the struggle of scaling up, and I know the struggle of fundraising, especially now when we are in the middle of the venture winter. Hopefully, fundraising in VC industry will start getting better this year, but we have what we have. So we have to be flexible, and we have to adjust to the existing industry there. I'm also a mom, which is, it's not a fact about my business life, but it's a fact about my personal life, which is also a fact in my professional and business career. And I know how to navigate a lot of things in at once. Maybe I can also teach you how to do that as well. So let's get deeper. And right now, I will ask you the first questions. Again, please be active. So share your opinions. What's a VC? What's, in your opinion, is a VC? Is anyone can answer my question? Okay, I kindly ask you to be as active as possible, but I can answer this question for you guys if you're not willing to answer. So the VC or venture capital firm is an equity fund provided by professional investors to invest in most prominent startups out there. VCs were created first to scale up startups, to bring innovation to global or local economies as fast as possible, for startups to forget about their operational needs, about their scaling needs, and to bring innovation as fast as possible. That's why it was created in the United States as the fastest vehicle and mechanism for accelerating startups. And that's why we see US economy as a leading and as a global one in a nowadays world. So VCs are good guys, not the bad guys, because normally I hear a lot from Ukrainian startups that VCs are really bad guys who are willing to take a part of your company and who are willing to do some bad things with your company. But VCs are great. VCs are guys who are created to make you grow and to bring your dream come true. Excuse me, if you are not speaking, I kindly ask you to mute your mics. So, another question, if anyone is willing to answer, is do startups actually need to fundraise? Maybe here you will be a bit of more active. If you are willing to fundraise, why are you fundraising?
To speed up an expansion, to have a more budget to run the marketing, to more geolocation, something like this.
So basically, you're fundraising to scale up your business, right?
Yep.
Okay. Maybe some other opinions out there?
I can also see an answer in the chat. Ivan is answering to grow faster.
Okay. That's great. That's amazing to hear that, because some startups or some founders actually think that they're fundraising to get a higher salaries out there, which is incorrect thing for the fundraising, because startups always have to keep in mind that VC or investors' money are the most expensive money that you can ever earn, because when you're fundraising, you're giving part of your equity, part of your company to a VC or to an investor. And you have to be really careful with all of those money that you are fundraising, because they have to be invested only in scaling your business, only in growing your company. In this way, it is the only way that you will be profitable in the future, and it's the only way that your startup will win the race and will win the market eventually. So please be concentrated on growing and scaling your business when you're fundraising. So who are the main players of the startup ecosystem, especially of the fundraising ecosystem? There are angel investors, venture capitals or VCs, corporate investors or CVCs. Sorry? Ina, kindly ask you to mute your mic because you're interrupting the sound. So there are corporate investors, private equity firms, there are accelerators and incubators. All of them are investing different checks. All of them have different theses. All of them are investing in different stages of startups, and we will talk about that a bit more. And all of them are formed in different way, and all of them have different psychology of investment out there, different fears, different wishes. And in order to build your fundraising strategy in the correct way, you have to understand the psychology of each and every fundraising ecosystem player out there. That will help you in your fundraising strategy a lot. And about the VCs, they are the most active players in the fundraising landscape out there. They are most active investors. There are a lot of VCs. Only in Silicon Valley, there are over 1,000 of VCs out there. And around the US, I don't know even how many of them. There are a lot of them. And they're the most active. They're investing in different stages. They're investing from pre-seed to Series D, E, F, and many, many others. So we have to know how they operate. We have to know their main fears, how they're constructed, and who are the main decision makers in the VCs. So VCs typically are formed and their life cycle is somewhere from 7 to 10 years. You have to keep in mind that really carefully when choosing the VCs to outreach or to work with. Because if you are outreaching a VC who is around, 8 to 10 years, probably they will not invest in you, not because you are a bad company, but because they are not investing anymore and they are in the liquidation stage already. So keep in mind that you have to approach, in order to be your fundraising strategy as active as possible, you have to approach the young VCs who are 2 to 3 years old or who have fundraised 2 or 3 years ago, not later than that, which is the most active timing for VC to invest. So as you can see, the first stage of a VC is fundraising. Yes, VCs are also fundraising, the same as you guys. And fundraising for them is even more stressful than for a startup because they're raising billions of dollars. From whom they are fundraising? VCs normally fundraise from family offices or just so-called rich families who have growing businesses out there and who are willing to distribute their risks and who are willing to distribute their financials and to give a part of their financials to operate by other enterprise like VCs. Also, VCs fundraise from governmental organizations like universities, like pension funds, different funds. So yeah, they're also raising from government as well. Universities are really actively investing into VCs. For example, 5 Global, which I've gone through, they're mostly invested by Stanford University. Why? Because universities are interested in scaling up innovation in the country. So they can be also active investors into VCs. Then after fundraising, we see normally like younger VCs who are not that represented in the market. They normally fundraise somewhere from $100 million up to $1 billion. But bigger VCs like Sequoia, Anderson Horowitz, they operate billions and billions of dollars because they have a name, they have reputation, they have credibility on the market, and they are able to fundraise more. After fundraising, VC builds its fund size and funding strategy. It's also really important thing to understand for startups. Investment thesis and investment strategy of the VC that you're willing to outreach or that you're willing to work with. If a VC says that they're investing only in Series A and Series B in mature companies, then if you are on the seed or pre-seed stage, it's not the best way for you to outreach them because you are not a fit for them. If the VC says that they're investing in B2B SaaS or they're investing only in AI and you are doing consumer product, it's not the best way to outreach them because you are out of their thesis of investment. So VC forms their strategy. Some of them are industry agnostic, some of them are concentrated on one industry. They're investing from early stage to Series A, some of them investing from Series A and follow-on. Also, there are different types of VCs according to the thesis. Ones are lead investors. The other ones are loving more to write the follow-on checks. That's also the thing that you have to keep in mind. If you are looking for a lead investor, then look for that in their thesis or ask the investor on your first interview whether they are willing to lead the round or they're normally are not leading the round of investment. The other step of VC leaving out there is the most active stage is deal sourcing, due diligence, and investment. Those are, as I've said, this is from first, second year of VC existence to fifth year, probably fifth, seventh year, probably, as when VC is actively investing. They're talking to thousands and thousands of startups. They are doing due diligence and they are doing active investment. They're going to startup exhibitions. They're going to events. Startup exhibitions as Viva Tech. USF an hour ago announced that they're picking startups for the Viva Tech. There will be a lot of VCs looking for different startups to invest in. And normally VCs end up in investing only in 1% to 2% of startups that they're talking to, especially now, because we, as I've said, we're in the middle of a venture winter crisis where due diligence process takes much more time than it was before. Due diligence is the process when a VC gets interested in your startup and they're starting to research your market, your business opportunity, your team, all of your documents, all of your loans and like things that like there are a million pieces in the due diligence process. If we're talking about 2021, due diligence took somewhere from 3 to 6 months for a VC to end up with an investment. And now, unfortunately, due diligence takes somewhere from 6 months to even 1 year and even 18 months to invest because VCs are more careful right now and they spend much more time on the due diligence process. After this active stage, there is a board representation, value addition, and follow-on investment. So that's the period of a VC from year 6, 7 to year 8, 10, probably. They are actively working with the startups that they are investing in. VCs don't just give you money. They work with the startups all the time. They help the startup. They share their network. They are meeting them with their future customers, future investors. They're helping the startups in the best way possible for them to grow, because that's the only purpose of a VC investment, to grow the startups. So they are adding a lot of value to a startup, and they do follow-on investments. Normally, if a VC led the round, for example, if the VC led the seed round of a startup X, during the A round of fundraising, they will do a follow-on investment into the startup, probably not the leading position, but they will do a follow-on as a normal investor, and startup have to look for another lead investor in the next round. After this stages, VCs plan their exits. Normally, 1 of 10 startups do a normal exit. If a startup fails, in terms of VC landscape, normally VCs expect you to grow at least 20 to 100 times since they have invested. If they don't see the grow that, if they don't see your performance in that way, probably they will push the startup to do an exit at least to return their investment. So they will push you to do an exit at a couple of $1 million. So they will get back their money and say goodbye, and everyone will be happy after that. Then they're providing the exit events. Then VCs distribute the profits. They are taking around 30% of exit to their team and operational costs. Then they distribute the profits among the LPs or people who invested into the VC. And then they liquidate the venture capital firm. So that's why I'm telling that year 7 or 8 of VC existence is not the best year to approach them, because on that time they are doing exit activities and they're not investing actively into startups. And about the stages, as I've said, from all of those multiple players of the VC industries, they are investing in different stages. They're writing different checks, and you have to know whom to approach on according to which stage you are operating in. So the first stage of startup existence is the seed stage, which is probably most of you are on the pre-seed or seed stage right now. So seed stage is a stage where startup is just getting started. You have your business idea, you have MVP, you have early traction, and you are looking for the first venture capital check in order to scale up and grow faster, to go to new markets, to launch new products, to, I don't know, whatever you would say. You need the money for first scale and first jump into the industry. Normally, the check size on the seed round is somewhere from 50,000 to 2 million. Of course, all of us saw giant checks on the seed round. Some of the AI startups, they tend to raise somewhere the checks from $60 million or something like that on the seed round. But the average check is from 50,000 to 2 million. And it's normally done by angel investors, friends and family, early stage venture capitals, accelerators, and incubators. All of them are early stage investors. Normally, I think 90% of the deals are made by angel investors because they're most active. They're not looking for huge revenue growth for the seed stage company, and they normally invest into the team and into the idea. So angel investors are most active on this stage. The other early stage of a startup is Series A of investment. Is the stage where startup has demonstrated a good level of traction, a good level of month-to-month growth, or ARR growth at least of 30%. Probably now it will be 50 to 60%. ARR growth, they have the good customer base, and here startups normally raise somewhere from $2 million to $15 million, and they also are talking to VCs concentrated on early stage investors. Sometimes corporate VCs can be involved into Series A of investment. Corporate VCs are normally made by huge corporates like, I don't know, Procter & Gamble, like Unilever, like many other corporates out there, and willing to invest into the companies inside of their industry with the future, willing to merge those companies. And those CVC normally invest somewhere from Series A, Series B, and further. They can help startups in terms of their growth, distribution chains, marketing channels, and growing their companies out there. I strongly not advise, if you're talking to some of corporate VCs already, I strongly not advise to get corporate VC as your lead investor, because they will have too much influence into your startup and technology, which can lead you to a not good spot out there. You have to be pretty mature to start working with the corporate VCs. There's a middle stage after that, Series B and C of investing. It's when the startup actually grows and actually starts generating millions and millions of revenue. And that's the place where institutional VCs, like bigger ones, come to the stage. That's where corporate investors and private equity firms also tend to invest. Banks are actively investing in Series B and C. That's where the real game starts. Normally, startups think that, oh, I will close my seed round, and that's going to be the hardest part, and that's the final part of my fundraising. But no, the actual game starts after Series B and C, is where founders start operating real money out there and start working with multiple financial institutions and start navigating really complicated financial processes in their companies. And you have to learn a lot about that from the very beginning of your company, and you have to understand how this complicated financial system work and whom you have to approach. And also, why I always tell startups that I talk to, that I work with, to start talking with as many VCs as possible when you're just starting your fundraising journey at the seed round, because hopefully, when you get to the B and C series of fundraising, you will have a huge network of investors, and it will be much easier for you to close your bigger round of couple of $2 billion if you have huge network out there of people who want to support you, who want to share their network, and who are willing to introduce you to all of those big guys on the industry with the huge checks out there. And later stage are Series D and beyond, which normally companies are getting ready for their IPOs and exits. Their checks are over 100 million and even billions of dollars. Yeah, and they're a hedge fund, and a lot of other companies are involved, which is too late for you guys and too complicated to talk about that right now. And then there is a dream stage of every founder, exit or IPO. That's the stage where you finally get your rewards for building your company. That's the stage when founders sell their companies to bigger players or make an IPO, and you start generating your personal revenue out there. You have to understand that when you are fundraising on all of the previous stages, you are giving your equity to multiple players, to VCs, angels, incubators, accelerators, etc. And normally startup founders end up having somewhere to 10% of their equity left. So most of the money go to investors into your company. And that's why I'm saying that VC money are the most expensive money that you can ever have. Because when we are reading articles about a startup who has done a couple of billions of exit, you have to understand that the founder will get only a couple of hundred of millions of this whole amount of money. All of the biggest part of this money will go to investors eventually. You have to always keep in mind on that and not give your equity, especially on early stages. Please do not give your equity to investors that you don't trust to. Don't give your 30%, 50% of equity to early stage investors. There's a huge red flag out there. Early stage investors normally ask somewhere up to 10% of your company. 10% is already a huge amount of equity to give to investor in early stages. So always keep in mind that when you will eventually do your exit, you have to understand that you will be the smallest person out there to get your money back, but you're the founder. So who are the main players on the fundraising landscape? Saying that all of you are really early stage companies, probably. Then accelerators or incubators probably will be your main target out there to get the first check of fundraising. Accelerators and incubators are kind of VC organizations that are made to teach and to invest. That's the vehicle for the VCs to lower the risks in early stage investment, because they are teaching you themselves how to grow your company, and they take the whole responsibility for startups because they're teaching them, and that's the way how they understand that their companies will grow. Recently, there is a huge trend where global huge VCs are opening their acceleration programs. For example, ARC is an acceleration program made by Sequoia Capital. Sequoia Capital is one of the biggest VCs in the world. So they have started their acceleration program. I really encourage you to apply there. Maybe you will make it there, and maybe you will get your first check from Sequoia and get involved into their acceleration program. Of course, there are leading accelerators like Y Combinator. Everybody dreams about getting into Y Combinator. There's 500 Global, there's Alchemist Accelerator, and there's the Techstars. So all of those accelerators are industry agnostic. They're investing in different companies. They're investing in early stage up to Series A, and they're working with different founders all over the world. There is also a plug and play accelerator, which is normally a B2B accelerator where they connect founders with B2B players. So startup founders at early stages can launch some pilots and test their products among B2B network of this accelerator. Also, there are accelerators like XRC Labs, for example, who have really narrow thesis of their investment. XRC invests only in consumer products or CPG products. There's also, for example, like Alchemist Accelerator, they invest normally in really complicated systems that need institutional growth and that need institutional and scientific approach to them normally. So yeah, you have to be really careful when you're picking your accelerator, and you have to learn their thesis. You have to understand in which founders they normally invest in order to succeed during the interview process. Because if you're applying to, for example, XRC Labs and you have an AI product, probably you will not get there because you're out of their thesis. So you have to learn a lot about acceleration programs. Who's the boss among the VC industries, among the VC investors? So of course, there are Andreessen Horowitz, there is Sequoia Ventures, the biggest investors out there, and they're really picky about the startups that they're working with. If you got the check from Andreessen Horowitz or Sequoia, there's a 60% chance that you will succeed on this market because they have a huge network, they bring you huge credibility out there, and they work really closely with the founders that they have invested in. So they will not just give you money and say goodbye for the following 10 years. No, they will work with you all the time because they're willing to grow you. That's why they're leaders in the market. Also, there is such a formation of the VCs who are founded by celebrities. For example, there's a Dreamers VC founded by Will Smith. There is Serena Ventures founded by Serena Williams. There's Sound Ventures founded by, oh my God, I forgot his name. Also a celebrity. Which is the best VCs if you have consumer product out there, if your business model is consumer wise, because this celebrity can become a face of your startup. They can bring you a lot of credibility on the market. They can bring you a lot of marketing activities. And it's great to work with a celebrity, of course. It's a dream of any startup out there, but it's really hard to approach those VCs because just imagine how many startups approach a celebrity VCs. So it's really hard to stand out among all of those startups. Also, there are CVCs, as I've said, as I mentioned before. There are corporate venture firms on the venture landscape, such as JetBlue Ventures, Prisma Ventures, and many, many others. Venture capitals formed by the corporate players out there. For example, Prisma Ventures is the venture capital firm formed by Ulta Beauty, which is a store of cosmetics out there. They wanted to give themselves a bit of a challenge of being an investor and innovative player on the landscape. So they have formed their VC out there. And right now they're really actively investing because they have formed 2 years ago and they are writing great checks for startups. So I also encourage you to apply and text them if you are building something connected with consumer products, AI in beauty or lifestyle out there, or AI in marketing, which is also be highly beneficial for you. So your fundraising, you are building a fundraising strategy. The first thing that I will ask from the founders out there, please don't do mass cold email outreach to VCs. VCs tend to get thousands and thousands of emails from founders on a daily basis. And they really feel and they really see if you are writing just a cold email through, I don't know, Hunter.io or some other software to do the mass email outreaches out there. Please do the personalized approach. Learn the VCs that you're working with. Understand their thesis, understand their portfolio, go through their portfolio and see their previous investments and previous checks. You can use a Crunchbase in order to learn which VC invests in which startups. Just open the Crunchbase, look for your competitors and see who invested at which stage in your competitor and approach those VCs and do the personalized approach. I really kindly ask you to do that because it's embarrassing. If a VC receives just a cold email from a startup, they will never reply you. The things that you have to have during your over your fundraising strategy. First thing, develop a compelling pitch deck. That's the thing that we'll talk about on our next workshop next Thursday. I will give my best tips and tricks on how to develop a good pitch deck and compelling pitch deck, or even investor deck. Second of all, build a strong network. Of course, it's hard being Ukrainians and not being involved into the US VC industry out there at all, but try to build your network. Add VC general managers into your LinkedIn. Connect with them. Text them something, like their post, and learn more about the VC that you're trying to approach, and build your network. Talk to them as much as possible. Even if you are not fundraising yet, but start building your network as fast as possible, because that's when you bring your trust. Because of course, if you are getting, if somebody connects you, trusted person connects you to a VC, it brings you more credibility and more chances that a VC will reply and you will have a chance for your first interview. Identify the right investors. As I've said, go through the investment thesis of a venture capital firm. In which stages do they invest? In which technologies do they invest? Go through their portfolio. Have they invested in this company on the Series A or pre-seed or seed round? So learn the website of the VC. That is what is created for founders to learn how this VC actually invests. Create a target list of your investors. It has to be at least 100 of VCs. Please tend to do 500 VCs or somewhere out there. Pick the top VCs from your list, like top 10 VCs that you're dreaming to work with, and leave them. Sorry? And leave them for later stages. Approach first the ones that are not that interesting for you, because you will do your mistakes, you will do your bad things with the VCs and with the outreach, but leave the best for the end. And then you will, because you will have a practice, and then you will be able to write the best emails out there for the VCs. Prepare your templates. Prepare all of the outreach templates, including, for example, normal template for a VC will be very short. Don't write huge emails out there. And please don't use the ChatGPT for your emails. It's horrible. Write an email yourself. So the normal email for a VC will look like, hi, my name is Dasha. I'm the CEO and founder of EFA. We're on a mission to replace blah, 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 or we're on a mission to build innovative AI product in blah, blah, blah industry. We have already generated our blah, blah, blah ARR, or we have reached, I don't know, 100K months over months growth. Right now, we are actively fundraising our seed round of, I don't know, $1 million. Please find our pitch deck attached. I would love to talk to you. Please book a meeting in my calendar link. Or you can also insert, I know that you have previously invested in X, Y, and Z companies, and that's why I truly believe that we might make a fit for your venture capital firm to invest. That's it. So please don't write those huge emails to VCs. They don't like to read them. And your pitch deck has to be perfect when you send them to your VCs, because normally VC, like investor, spends around 30 seconds of their time on every slide of your pitch deck. So it has to be perfect. It has to be understandable. It doesn't have to contain a lot of text, and it has to be really compelling to investor that you're a professional person out there willing to raise a lot of money. Demonstrate traction and milestones. As I've said on your first email, you have one chance to get your first call with an investor. So insert anything compelling about your startup. Insert your traction, ARR, partnerships, big names that you're working with. That's your only chance to get your first call. When you will get your chance to talk with your first VC on the interview, don't be afraid to ask questions. Normal questions to ask are, how involved are you in startups that you are working with? Are you willing to take in any board seats? Are you investing in straight equity or safe rounds or convertible notes? And you have to understand that from the very beginning when you are building your financial and fundraising strategy. If you will have any questions on straight equity rounds or seed or safe rounds or whatever, I can answer them after the workshop. And be persistent and resilient. Fundraising is the hardest process that the founder can ever go through. That takes months and months and months of a very hard job out there. If you have a couple of VCs actively talking to you and you're going through second and third interview, that's not shows anything. Any one of them can tell you no at any stage out there. Even if you have already gone through due diligence process, a VC can say no to you for multiple reasons out there. You have to have a lot of investors in your pipeline that you're actively talking to, and then you will be able to fundraise and be really persistent on this process. It's extremely hard, especially now. It takes over a year to close the round. So please stay calm and proceed with finding your best investor. And of course, for early stage there is a bunch of opportunities for early stage startups, and Ukrainian Startup Fund have created this amazing opportunity for startups as a Seeds of Bravery, which is a grant opportunity for startups to keep you growing while you are fundraising. It's a long process. So here you can get some kind of a free money from government in order to cover your operational growth, sales, other costs out there. So I really encourage you to apply for the Seeds of Bravery and look for professional advice on how to apply there. And I really hope that you will make it, and it will be easier for you to bootstrap while you are fundraising and show better results for the VCs when you're approaching them. Also, I have included, you can do the screenshot. I have included the whole list of terms that you have to know when you're talking to VCs. The main ones are thesis, as I've said, investment thesis is where VC invest, and that's a normal term. When VCs talk to you, they can say, our thesis is blah, blah, blah. So you have to understand those terms. Due diligence, or DD, which is normally called on emails, they call it the DD, which is a process of checking all of your documents, your market potential, and things like that. Evaluation is your company evaluation, pre or post money evaluation, normally startup. If you are raising first time, you name your pre-money evaluation, which is how much does your company cost right now and how much are you willing to give out of to your investors. If you are raising your second round, like later seeds or A round, normally startups say post-money evaluation, which means their evaluation after the last round of fundraising. Also, there is term sheets, which is a proposal of a VC to a startup, including all of the conditions of VC investing in your company. Cap table. Hopefully everyone here knows what the cap table is, which is the table of or chart with all of the equity which belongs to co-founders, VCs, previous investors, and people like that. But yeah, go through that list. If you have any questions, please approach to me. I will answer all of your questions. Also, there is a couple of good books to read when you're building your startup, when you are building your fundraising strategy. I really encourage you to read The Hard Thing About Hard Things by Ben Horowitz, which is an amazing book to read when you're starting your company and you are willing to know how it's actually built, what are the main things to get your attention to when you're building your company, and how to start thinking corporate, even if you are having only 2 people in your startup. But you have to keep in mind that you're building a huge corporation in the future, and you have to understand the main key points of building all of this huge company and huge rocket that will go to the sky. And always keep reading LinkedIn, Bloomberg, X, or Twitter, and TechCrunch. The main news and trends are there. You will get your understanding of the main players of the VC and startup industry, the main trends, in what VCs are investing right now, which checks are they normally writing, and you will get your knowledge better into the ecosystem out there. Thank you so much, and let your money fly to the sky. And I'm wishing you the best checks possible out there. And I'm wishing Ukrainian startup ecosystem to get out there into the world. And I really wish that I will see a lot of TechCrunch news on Ukrainian startups closing huge rounds out there. Thank you so much, and ask your questions.
Thank you, Dasha, for a fantastic dive into fundraising today. Let's move to the Q&A session part. So we have a few questions here in the chat. The first one, is VC applicable for sums near $10,000? I heard that it takes a lot of time and forces.
I didn't catch the question. If the VC invests $10,000?
Is VC applicable for sums near $10,000?
Probably not. VCs normally invest somewhere from 1 million or at least $500,000 to a startup, because you have to understand VC's psychology on that. If the VC invests in a startup, they want to take a normal part of your equity, at least like 5 to 6%, because this is the part where they will get their money back. If they will invest $10,000 in your company, they will get at least than 1% of your company. It's not interesting for them. You have to understand that you have to give your equity, then they will be interested in working with you, and then they will be interested in growing your company. So yeah, they're normally not investing such a small checks.
And then the next question from Ivan as well, how to get less than $50,000?
You can get grants, as I've said, Caesar Brewery, USF grants. They are giving somewhere, correct me if I'm wrong, Yana, they're giving somewhere from $25 to $50K to pre-seed and seed stage companies, right?
Yeah, it's the grant from USF and Western AS Enterprise Fund. But with Seeds of Bravery, you can get up to 65,000 euros.
Yeah, And you have grant opportunities for $10,000 as well. So those are smaller checks dedicated to your specific needs, whether it will be marketing needs, manufacturing, marketing, I've already said that. I don't know, building your brand or something like that. So those are smaller checks that you can actually get, and you can actually build something with smaller money, and then you will be ready to get your fundraising.
Thank you. And the next question is from Val. Is it normal for VCs to invest in a potential competitor that they already have in their portfolio?
Oh, that's a really good question. Normally not, but you have to understand the stage where VC invested in your competitor. If your competitor has already done an exit, then the VC can invest in your company because they know your product, they know your market, they have already built this company and made it to an exit. So that will be the perfect recipe for a VC to invest in you because they know how to build this company. But if a VC invested in your competitor a year ago or a couple of months ago, no, please don't text them because it's out of their thesis and they will not grow two competitors out there.
Thank you, Dasha. Do we have any more questions? Please don't be shy. Go ahead.
Yeah. Hi, Dasha. May I ask you why most of the VCs prefer to be the following investors, not the lead one? Why it is so hard to find exactly the lead investor?
That's a very good question, and I understand that probably you are fundraising right now because you know the struggle. You know this for real.
Not really, but fortunately for us, we always attract the attention of the investors, even if we're not fundraising. That's why I adjust my own statistics.
Okay, so it's the question of a risk mitigation for a VC. To be a lead investor is to take all of the responsibility for a startup. Is like lead investor, they make the rules of the game, if we can say that. They state the company's evaluation. They state all of the conditions of investment. So all of the follow-on investors just go after the lead investor. So being the lead investor is the most risky part out there, and they are writing the biggest check out there. So all of the other VCs are just waiting for someone stronger to lead this round. It's extremely hard to find a lead investor, especially for the early stage company, especially in the current conditions that we're having, considering the venture winter and things like that. Yeah, it is hard, but you have to keep looking and you have to keep approaching to the investors and to find your lead investor. There are some VCs who are always tend to be only the lead investor. Same Sequoia and Anderson Horowitz, they're only leading the rounds. And there are a couple of other VCs in different industries. You can check on the Crunchbase that they're almost 90% of their investments are lead investments. And then you have to reach out to those VCs.
Thank you.
Thanks a lot. The next question from Alexei. Can you tell more about so-called bad money? What investors should be considered as bad ones? What should we avoid?
Bad investors. So there are a couple of red flags when you're talking to a VC or investor, an angel investor. First of all, if they are asking for more than 10% of your company at early stages, and they're writing like $50,000 check, that doesn't make any sense. That's a huge red flag. So you should stop talking to them immediately. And those are not investors that you are willing to work with. Second of all, kind of a red flag is an investor who wants to do equity or price round on your seed stage. Normally, normal investors, they tend to work on safe note or convertible note on the early stages because price round or equity round will take a lot of time and a lot of money for lawyers in order to finalize this round out there. The other red flags are investors out of your technology, out of your business out there. If they're normally investing in, I know, blockchain, and you have CPG product and they are willing to give you money, probably it's not the best way because they will not help you in any way. It will not be smart money out there. They will just give you money and will ask you for results without understanding the market, without understanding your market potential and your, I don't know, breadpoints of growth somewhere. So you have to look for a VC with the experience in your industry. What are other red flags? If an investor doesn't reply your emails for a while, it's probably they're not that interested, and probably they're not so interested in you as a founder. So stop approaching them within like 2 weeks if an investor doesn't reply to your emails. I think, to my mind, that's all of the red flags that I can actually imagine. And look for the LPs. Yeah, if the VC, if you are not compelled by the LPs or by the money that is operated by the VC, that's normally happens in countries like Southeast Asia, Dubai, and all of those countries. If you're not so trusted in the money that are operated by this VC, then I will not encourage you to work with this VC, because that can be corruptive money, that might be money from mafia or somewhere, and they can just stop investing in your company at the moment when you don't expect that. So you don't want to be too connected with that. Check the background of the VC carefully when you start working with them.
Thank you. And we have one more question from Alexander. What benefits a good VC could afford except of money? How to ensure that investor will really take active role in startups growing?
How to ensure their activeness in your startup growth? Ask your questions. When you talk to investor on your interview process, ask them, how active are you in your portfolio development? How actively are you involved in your like monthly or quarterly calls with your founders? Do you actually get your hands on marketing, product development, or sales development of a startup? What could they bring? That's the thing that they can bring. They can bring their knowledge and experience if they have already built similar products. So they can give you their professional advice on that. And they can share their network of investors or corporates, because some of the LPs of a VC might be huge corporates that might be your customers. So VC can introduce you to those customers, and you can get an easy access to huge corporate customers out there if you're working B2B. So all of the things connected with your future development might be brought to you by a good VC if you will be lucky enough to get a check from a good VC.
Thank you. And even more questions are ahead.
Yeah.
Can you suggest on milestones a part of signing clients or pilots to share with investors at data room or and email updates?
Okay, so yeah, of course, the main thing is your ARR or MRR or month-over-month growth. That's the main thing that investors are interested in, or partnerships. But you can also include it. That highly depends on the technology that you're working with. If you're building something for marketing needs, then you can, or you're building consumer software, then you can include drop down in your customer acquisition cost. You can show that you became more cost effective. If you are building something hardware, you can share information about your mass manufacturing, patenting, and things like that. Patenting adds a lot to your company evaluation, so you can definitely name that if you got the patents recently. You can share information about the team. If you have hired somebody outstanding out there, please don't include just the things that we have hired 2 QAs into our team. It doesn't make any sense for an investor. But if you have hired a high-level salesperson, or you have hired a high-level CMO or technical person to your team, that could be worth including into your email list for investors.
Thank you for your answer. Another question, what about fundraising on Kickstarter or on Patreon and other social platforms?
Okay, so it's like a mass fundraising or something, or crowdfunding, crowd fundraising. Kickstarter is good if you have a hardware product, consumer product out there, but you have to understand that in order to get substantial check from Kickstarter campaign, you have to invest at least 10 to 20K dollars into your Kickstarter campaign to develop marketing, to develop your brand, to get first customers, to get first interest. So it's not a free thing to do out there. And you have to learn a lot and understand how Kickstarter operates, and you have to partner with trusted marketing partners of a Kickstarter in order to launch this. About the Patreon, I don't really know how they operate, because the biggest problem of crowdfunding is how will you documentally form your fundraising round? Because I saw startups who did crowdfunding and then they had 100 investors in their cap table, which is a perfect recipe for a disaster. You will never fundraise if you will have a lot of people in your cap table. So if your crowdfunding is formed with only one player out there, like a Kickstarter, for example, they take the share with just the Kickstarter, like one investor, that's okay. If there are like requirements to enter all of those angels or whatever people investing into your company, don't do that. That you will do a very bad thing to your cap table.